The doomsday clock ticks. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the warning bells are ringing as this economic omen is signaling that terrifying times are ahead. And what's interesting is right now, investors, policymakers, and other experts are saying that just because a recession hasn't happened, even though we've seen investors prepare and brace for a big downturn in stocks, that now because it hasn't happened, that a soft landing is the base case. Yet this indicator has had a flawless track record of calling the last 8 recessions, and now many are saying it's completely wrong. We're going to show you why it's going to nail the 9th one, just as it always has. Now, if you're wondering what we're doing in front of the European Central Bank today, well, they raised rates as they're saying that they're not trying to trigger a recession. We're going to show you why they're absolutely going to send the entire Eurozone and likely the rest of the world down with them. Plus, we're going to take a look at what's going on in U.S. factory prices today as we're starting to see perhaps a resurgence in inflation. And is the U.S. consumer back? Well, we're going to make the case. Well, to this month's bump in retail sales is nothing more than an anomaly before it heads a whole lot lower. Plus, we have a sponsor for today's show who is a downstream energy and transportation company that just announced something that no other sponsor on our channel has ever done, and that is a major stock repurchase program as they look to not only put a floor on their stock price, but also to send it higher, which we think could go up as much as 25%. Stay tuned to the end of the show or check out the description or pinned comment for more information. Now let's head over to Bloomberg, where we picked today's story up with a headline: the ECB delivers its 10th hike as Lagarde won't quite confirm the rate peak. Now, of course, we know that central bankers never confirm anything because there's no reason to. The answer is they don't know. If they knew what the peak rate was, if they knew where the terminal rate or what was necessary to bring inflation down to a normal level that everybody could be happy with, well, they would simply move rates to that overnight. There would be no reason to take these gradual steps and say, well, we're not sure if we quite got it yet. But as you're about to see, they're getting concerned about sending the economy into recession. I'm going to show you why. Not only is the ECB going to send one there, but so is the Fed and all the other central bankers. As you can see, they increased their deposit rate to 4% from 3.75%. And with today's decision, we have made sufficient contributions under the current assessment to returning inflation to a target in a timely manner. Now, we could argue that this is the opposite of what they should be doing. When inflation spiked, they should have all raised rates significantly and then brought them down slowly. Instead, they raised them slowly, saying, well, we are not sure why the data is what it is, but we'll raise it a little bit more, because that's what doesn't work. And so we're seeing now some early signs, not just out of the ECB, but we'll likely hear from the Fed next week, that we've got rates at a sufficiently restrictive level, but we're not quite sure if we do at all. And here we can see the focus is probably going to move a bit more to the duration in terms of how long they're going to keep rates up, but it's not to say, because we can't say, because we really don't know, that now we're at the peak. And here we can see, looking at the federal funds rate in red against the consumer price index shown on a year-over-year rate change in blue, what you always see is the reaction component from central bankers. Inflation goes up and they just don't know how to handle it. Instead of actually just raising rates up really high and then gradually bringing them down until they find equilibrium, they chase rates higher only to find out something goes wrong, and then they start cutting, usually in advance of a decline in inflation, as you can see time and time again. The only exception right now is current times, because for whatever reason, the Federal Reserve and other central bankers, they actually believe what happened here in the 1970s, where inflation took off and came back down and then resurged, they think that's going to happen again, because their textbooks tell them. Of course, what they don't know is actually what caused the inflation and why we're not going to see that happen again. The governing council repeated language that will keep borrowing costs at, quote, sufficiently restrictive levels for as long as necessary, and that could keep the door open for further hikes should inflation prove to be more sticky than thought. And it also could keep the door open for rate cuts if inflation doesn't stay as sticky as anyone thinks. And that's, of course, central banker language. It is very important that I want you to understand that they have absolutely no clue what they're doing, and yet we put them in charge of the monetary system, and when they do this, almost with an entirely perfect track record, they cause recessions. And that's what's important about our headline story today, because we have this signal that's been flawless. 8 out of 8 of the last recessions it's nailed. Today people say, no way, it's totally wrong. And that's why we're making the case. It's going to get it right for the 9th time, just as it always has. Inflation has declined, and we want it to continue to decline, even though we have no idea why it's declining. We're doing that because we want to force we're not doing that because we want to force a recession, because we want price stability. And yet on this show, we've made this case before that when you bring prices down rapidly, you also bring demand down rapidly with it, and that's what leads to a recession. And in fact, you can see that. We're going to go back to the last chart here, and I made some marks that I want you to see where you find peaks of inflation, you also find peak federal funds rate. So what happens then after? Well, with every time you notice, perhaps about once that I could see on here, you don't get a recession. So you notice even going back in the 50s, Fed raises rates, recession, raises rates again, going into the 60s, recession. You see another recession. Again, every time the central bank raises rates with some sort of lag, at some point, what follows is a recession. And they almost know it, because you'll see that in the more modern times, they've started to get the feeling ones coming, and they lower rates only to trigger recession anyways. And you'll notice these big declines in the consumer price index. That's a big decline in demand that's going to drive rates down. And while right now everyone's thinking that this is, again, the repeat of the 70s, we're going to get that resurgence of inflation, we're about to make the case of why that cannot happen at all. And what central bankers are going to do is chase this thing back to zero, and probably negative. Of course, we know what causes this. Every time the Fed or any central bank raises short-term interest rates, they ignore the market, and this is very important. They don't look at the bond market at all and say, wait a minute, the bond market is telling us that our outcome, that our models, or whatever it is we're doing to come up with our formula for raising rates, which, by the way, they don't have one. They just arbitrarily do whatever they think to get the hopes, to get the outcome they want. But if they listen to the bond market, and they actually did this carefully, they could possibly engineer a soft landing. But instead, what they do is they make the biggest mistake you can do in a debt-based economy, and that is contract the creation of money. When you do that with almost a perfect, and we're not talking recent historical, we're talking long-term historical effects, you get a recession. The longer you go about constricting the creation of money, the worse it eventually gets. And we can see that effect here in the yield curve. So anytime you notice, this is now the 10-year, 10-year yields minus 2-year against the consumer price index. Anytime you see these inversions pop up, and this will feed into our future story here, so hang tight on that, you'll notice recessions follow, because what is happening when the central banks do this, they're ignoring long-term rates. They're ignoring the fact that the bond market is an excellent predictor of future inflation and growth expectations, and so they ignore it. They cause then the banks to tighten lending standards, as we can see on this chart, now showing the net percentage of domestic banks tightening lending standards for commercial industrial loans to firms of all sizes. And so it's only then a matter of time when banks tighten lending standards and then start to constrict how many loans they're offering, which is, again, money growth in our monetary system, you eventually squelch demand in a big way. And right now they're saying, look, hey, we're not trying to create a recession here. No, you're trying to create a financial crisis and a depression, because you've ignored the bond market for such a long period of time that you think you know better than it, and they don't. And that is a huge problem, because the bond market, well, it's got a track record that almost no expert can beat. as the bond market has never sounded recession alarms for this long, as the 10-year yield has been below the 3-month. Now, you notice on the last chart we looked at the 2-year at below the 3-month rate for 212 trading days, and based on Bloomberg's research, that is a record. And this is a huge problem because investors have, remember, back at the last peak, we saw, of course, the banking crisis back in March. And what did investors do? They actually positioned themselves for a crash, and they almost never do that. And the timing looked really good. And what has happened since? The market didn't continue to go down. In fact, it looks like everything's okay. And so the stock started to go back up. And what have we seen? This massive releveraging into risk. And then in turn, because the stock market's gone up, what have we seen other experts and politicians and policymakers start to believe? Well, there must be the case for a soft landing, because if the market's not crashing and things aren't going wrong, and of course the yield curve here is completely off its rocker, well then by all means we should be seeing a soft landing. The problem is a lot of people don't understand. The issue here is we had a massive amount of fiscal stimulus get into people's pockets, and when does it go away based on projections? Well, if you guessed, it's the end of this month. So that means we're dwindling down to the last bits of pandemic stimulus, and it's taken a very long time to get rid of this money. When it's gone, watch the teeth of the yield curve kick in a big way as money disappears. The apparent disconnect between the market's warning and the surprisingly resilient economy shows just how much uncertainty has persisted since the Fed started its aggressive rate hikes in March. And that's not what it is at all. It's the bond market saying, look, it's not uncertainty. The bond market's saying, look, Fed, you think inflation and growth expectations are way up here. We're saying they're way down here. That is all it's saying. It's not pricing in uncertainty. It's pricing in what is a likely outcome of what is to come. The cycle has been an odd one because when the yield curve originally inverted, most expected we were on the verge of a downturn. And this is true. If we were to go back and look at that chart, you'll notice it doesn't take much of inversion to slow down the money creation and burst the bubble. And that's just the key. When you look throughout history of central banking policy, if you go do research, there's plenty of books written about bubbles. All it takes is a slight slowdown in the credit creation or the money printing mechanism for the bubble to burst. And that's why in the past you look at the yield curve inversions and it doesn't take much. It could be a slight inversion, it could be a minor inversion, and next thing you know, it just slows it down enough and all of a sudden the bubble pops. This time it hasn't done it. It all comes back to all of that pandemic stimulus. Once that's drained out and gone, watch this bubble just explode. The surprising strength of the U.S. economy makes the odds of a soft landing much better than they were a year ago, but it's nowhere close to a guarantee. Of course, if you look at the strength of the U.S. economy based on the pandemic stimulus money, it makes sense. Take that away, and you can go away with a soft landing as well. And still, the inverted yield curve can be a self-fulfilling prophecy. That's in part because its successful track record may cause businesses and consumers to cut back, which is outright ridiculous, seeing it as an accurate predictor of trouble ahead. Now, let me ask you this, because some of you own businesses, work for big corporations, or even small businesses, or you're going out and spending your own money. When is the last time that you've gone out to buy something and say, you know what, I'm not going to buy this because the yield curve's inverted, and that tells me that maybe something bad is coming? Do you know the last time we've seen a corporate press release or a major CEO of anybody from any company come out and say, you know what, we're changing how we're going to run our business and our spending habits because the yield curve tells us so? If you said none, well, you got it right. It also ripples through the credit system by giving banks less incentive to extend loans. Aha, now we're getting somewhere. It's not less incentive because the incentive of being in business is making a profit. And since they borrow at the short-term rates and lend at long-term ones, when the curve's inverted, they lose money on loans, so they can only make money on fees and origination costs. Recently, the yield from a portfolio divided 60-40 between stocks and bonds was less than investing in 3-month T-bills, but that will change when rates come down. And a thriving finance-based economy cannot do well if low-risk investments yield higher than the high-risk investments. This according to Bill Gross, the former chief investment officer, or who is known as one of the 2 bond kings of Pacific Investment Management Company. And he is right. When these curves are abnormal, when short-term rates are above long-term rates, it doesn't work. Our financial system, our monetary system is not designed to work on this at all. Now, maybe in this short term, it appears that it doesn't matter. But when you put the banks at a point where they cannot make money lending, they do the natural thing that any business owner does when they don't make money selling a product or service. They stop doing it. And in the case of our debt-based economy, when you stop creating new money, at some point, you burst the bubble. The bigger and longer the period that you contain or contract money creation, the worse it's going to get. And Campbell Harvey, the Duke University economist who pioneered the use of the yield curve as a recession indicator, says its predictive power remains intact, and we agree with him. He has focused on the average level of inversion for over months instead of the number of consecutive days, by of which we're saying doesn't matter at all. And by that measure, he says the recent spell doesn't look particularly long. His tally shows it was inverted over a 15-month period before the recession that started at the end of 2007 and for 18 months ahead of the one in the 1980s. The inverted yield curves have forecasted 8 out of the last 8 recessions without a false signal. Of course, we know the central bankers have actually caused a recession 8 out of the last 8 times. And of course, Harvey goes on to say, ignore the signal at your own risk. And we're saying you shouldn't ignore it at all because it's just a matter of time. It's always been a matter of time. When we see again the destruction of money in a debt-based economy, bad things eventually happen. And when you start to look at the health of our economy, it's not just about the consumer. Usually you see consumers continue to spend during recessions, because simply, we still need to buy stuff. If you look at the small and mid-sized regional banking system, on top of the fact that the curves are telling us money is being destroyed, you have all the makings for an eventual not only bubble bursting, but outright financial crisis as we see a whole lot of banks fail. But yet, there's still hope the economy's turning around because the factory sector is telling us that perhaps inflation's coming back. But is it? U.S. producer prices rise the most in more than a year on energy costs. And we talked about this in a show recently. Of course, producer prices have a strong correlation, as we'll show you, to West Texas Intermediate crude oil, whereas consumer prices are more tied to gasoline prices. Here you can see the producer price index for final demand increased by a whopping 0.7% from a month earlier, which will give policymakers all the belief they need to say inflation is about to roar back. And yet, on the back of this, gasoline surged 20%, accounting for much of the gain. Take out food and energy, key thing here, the producer price index rose a mere 0.2%, suggesting it's all in those two sectors. And while normalizing supply chains and the slowdown in many economies abroad have generally helped alleviate inflationary pressures at the wholesale level, rising oil prices will validate this, threaten to unravel some of that progress, but will make the case that this isn't a long-term issue. On an annual basis, the PPI accelerated higher for the second month following a year-long downward trend. And here you can see the producer price index shown on a year-over-year rate change in blue, that as final demand against West Texas Intermediate crude oil prices, that in red. You can see the beautiful relationship here. Crude oil prices indeed rose, and we saw producer prices follow. The question then is, are we about to see a continued increase in the year-over-year change in crude? Well, here we are looking at the last 12 months, and you can see that as crude oil prices come down into January, you see of this year, that should keep the year-over-year comp rate actually somewhat high, suggesting that producer prices do go back up. However, if we see crude oil prices get down in the $70 to $80, $75 to $80 barrel level, you'll notice that the year-over-year comp is going to be zero. If it goes down further, we could actually get some negative prints back in the system here, suggesting that unless crude oil does go higher, that we're not going to see a big resurgence of inflation, at least not out of the factory sector. And here you can see the relationship between the consumer price index and the producer price index, suggesting that again, final demand, which has passed on to the consumers, they're running lock, stock, and barrel here. But the question I'll hold on to and maintain is this isn't going to last a whole lot longer, because again, this all comes back to demand, and demand is a function of people being able to access money and spend it. And in our debt-based economy is fueled by debt. The ability for consumers and businesses to borrow money they don't have, to buy the stuff they don't need, and that leads to growth. Well, that's the mechanisms of our economy. You strip that away by keeping the banks from lending, and eventually demand comes crashing down along with inflation and producer prices. But here we can see U.S. retail sales top estimates on higher gasoline prices. We'll say probably that's not going to last for long either, as the value of total retail purchases increased a whopping 0.6% from July, following downward revisions to the two prior months. Again, we're keep seeing these downward revisions. Take out gasoline, so we're seeing where people are spending their money. Sales climbed a mere 0.2%. Of course, these figures aren't adjusted for inflation, and what this is telling us is that exactly what I've been saying for a while, that higher energy costs are not good for discretionary spending. So what we should see is, of course, as retail sales growth head lower, particularly after September, when we see this pandemic stimulus is totally gone. And even though the figures still point to resilient spending, the report shows how consumers are feeling the pinch of higher prices, particularly those at the gas pump. And some Americans are relying on credit cards and savings. We know they're tapped out, and a slowly softening job market. Despite rising real wages and a rebound in wealth, the mighty consumer seems to have stepped back in August due to higher rates, cost of fuel, and fading excess savings and slowing job growth. Of course, all the cases that we've been making on this show. And something that we think is headed higher, well, that's the stock of our sponsor for today's show. And that is Titan NRG. You can find them on the OTC on the symbol TTNN. Again, on the OTC, TTNN. We got all the information in the description and pinned comment below. And this company has done something that no other sponsor on our show has, and that's a share buyback. But Titan NRG is a holding company that operates on a downstream energy and transportation company through subsidiaries. There are currently 25 plus transports in 9 states, with retail propane serving southern Arizona with 1,500 leased tanks, wholesale purchasing and sales, and along other things, as they're focused on vertical integration while expanding their operations to cover everything from the refinery all the way to retail. And something we think is going to be going much higher here is their stock. Now, they just announced the buyback program effective, as I'll show you, September 1st. And look at this. Notice the RSI. The momentum here is building is 50 and it's picking up steam. Look at the MACD down here. Run this on your own charts. Again, symbol TTNN. You see a positive cross from down here in deep oversold territory. Momentum is switching and building to the upside. And if they're holding support here around 25 cents a share, where they announced the stock as of this morning was trading around 30 cents, we think this could get up as much as 40 cents a share, and that will realize a potential 25% gain. And here you can see the announcement just came out on September 11th, as Titan NRG, a leader in downstream energy and transportation, has approved a share repurchase program with authorization to purchase up to 3 million shares of its preferred and or common stock through September 1st, 2024. This is a strategic move that will have a positive impact on the company's future, and this is something we think is going to be fantastic, because they're saying, as we see here in the report, that it showcases its unshakable confidence in the strength of its financial foundation, which resonates with both existing and prospective investors, who can rest assured knowing that the company is unwavering in its mission to protect their interests and actively work towards maximizing shareholder value. But what else they're maximizing is their balance sheet. This company's got positive cash flow, they've got money in the bank, and all this tells us is their position to really drive their stock price even higher. Now, as we zoom in, of course, we can see the technicals. There's the RSI building the momentum. There's the MACD, that nice positive cross from deep oversold territory moving higher. You can see before support was at 16 cents. Now, thanks to the share purchase program, we believe that number is going to be around 25 cents a share, and they're going to be purchasing this over the next year, and that could send stocks again, with a stock up, when I believe 25% to our target of 40 cents a share. Here you can see their first fiscal quarter, they've got revenue of almost $2 million. They've delivered a net comprehensive income of over $200,000 versus a loss the last year. Their accounts receivable is up to almost $800,000, and they've got financial resilience with $1 million in cash on hand. So this company is positioned financially to see their stock price higher. And sure enough, as we zoom in to the 30-day window window. Here you can see support on the volume profile, 25 cents a share, and that's the level we think the company is likely to continue to defend as they continue to purchase their stock over the next year. But as always, with any company we feature on this show, you're under no obligation to purchase their stock. Be sure to do your own research before buying or selling anything. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.